This expanding number of current BRICS members generate and or consume the lion's share of the multi-trillion-dollar oil and energy complex. The successful adoption of this alternate SWIFT settlement currency will drive this unfactored, highly inflationary dedollarization process. Now, commodities priced in gold will be stable. As the multi-trillion-dollar oil trade increasingly migrates into the BRICS gold-backed clearing mechanism, it's going to require additional central bank gold to be purchased, which will ultimately force global gold price revaluation on the Western BIS compliant central banks, who on average have around, as I say, 4% gold versus GDP backing their respective fiat currencies.
As an independent London metals trader, AndrewMaguire's journey through decades of navigating the intricate nuances of the market has solidified his reputation as a leading authority in the field. In this video, AndrewMaguire peers into the future, envisioning a seismic shift as BRICS nations pivot oil trade settlements to gold-backed systems. This move is poised to trigger a surge in central bank gold acquisitions, necessitating a global revaluation of gold prices. With the strategic inclusion of major oil producers like Russia, UAE, and Iran, alongside critical consumers India and China, BRICS not only signifies a shift towards a multipolar world, but also poses a credible challenge to the petrodollar system through the potential introduction of a BRICS common currency. For instance, India's formal agreement with the UAE for rupee settlements, including significant crude oil transactions and similar arrangements for Russian oil imports, illustrates a strategic pivot away from dollar-centric trade. Highlighting the stability of commodities priced in gold amidst this uncertainty, Maguire draws attention to covert gold acquisitions by entities like the People's Bank of China, which are integral to a strategic dollarization process. Meanwhile, the People's Bank of China has been gobbling gold for over a year. The central bank has expanded its gold reserves for 16 straight months, adding over 300 tons of the yellow metal to its stash since it resumed reporting gold purchases in October 2022. At the same time, the Chinese central bank has been dumping U.S. treasuries. Reflecting on recent events, Maguire emphasizes that the Federal Reserve's management of its gold reserves poses a new risk to the global economy. He suggests that the Fed's actions echo concerns previously raised about China's influence, underscoring a significant shift in global economic dynamics. Now, we present the clips of AndrewMaguire's insights from his recent interview with Kinesis Money. Before we continue to delve into this discussion, please subscribe to our channel and activate the bell icon for timely updates.
In summary, what has accelerated the current 2-month paper to physical divergence is the race by central banks to diversify into physical gold. Now, the gold rally has almost exclusively been driven by Russia and China aggressively buying physical gold to provide sufficient liquidity to back Glasniev's alternate beta-attested gold-backed commodity currency. So given that this expanding number of current BRICS members generate and or consume the lion's share of the multi-trillion-dollar oil and energy complex, the successful adoption of this alternate SWIFT settlement currency will drive this unfactored, highly inflationary dedollarization process. Now, commodities priced in gold will be stable, but as the multi-trillion-dollar oil trade increasingly migrates into the BRICS gold-backed clearing mechanism, it's going to require additional central bank gold to be purchased, which will ultimately force global gold price revaluation on the Western BIS compliant central banks, who on average have around, as I say, 4% gold versus GDP backing their respective fiat currencies. They're going to need to up that. And this leaves the Fed, the only central bank still betting against gold. Empirical evidence indicates that a significant percentage of the 8,133 tons of Treasury gold the Fed manages on behalf of US citizens are rehypothecated. This indicated that 4 to 5% of gold they purport to have to back the percentage of foreign debt outstanding is actually in reality likely massively in deficit, a negative number. In other words, the Fed's only solution other than to default is to revalue Treasury gold to market. One thing for sure, oil priced in dollar terms will diverge significantly higher, and estimating the layered scale of BRICS adoption, by the end of the year, liquidity providers estimate $200 gold oil is entirely possible. And if gold is not revalued to market by Western central banks, the inflationary fallout stemming from oil priced in unbacked dollars would be sufficient to trigger a too big to fail derivative market implosion. This could not be averted. And you can ask anyone, if gold was trading at $200 to $300, what kind of a derivative implosion would happen? Now, a very likely South China Sea or Taiwan escalation looks increasingly possible, even if it's by mistake, and if triggered, likely gets close to Russia's estimate of $300 per barrel. Yet oil and commodities priced in gold would be relatively stable. That's what's spooking these officials. Large covert monetary gold purchases by the PBOC reflect a ramped up strategic dedollarization process. And if you go back a few episodes where we focused on how China had been able to covertly accrue some of this 40,000 tons of gold by exchanging some of their hidden over $3 of FX of the FX shadow banking reserves that the U.S. Trade and Treasury representative, which was Setster, Fed is as best as possible trying to manage the exit of their 8,133 tons of largely rehypothecated Treasury positions, spurred by what our liquidity providers report is an overwhelming queue of foreign central bank repatriation quests. Some of them are not even on the record. Ironically, all of this echoes Setser's concerns about China posing risks to the global economy. In fact, it's echoing Setser's word. It is, in fact, the Fed that is now presenting a new risk to the global economy.
In his recent interview, AndrewMaguire mentioned a major shift in the gold market, with a $400 rally driven by broad acceptance globally. He further noted that NSFR-compliant central banks see this surge as advantageous, strengthening their gold reserves without tapping into revaluation accounts. The gold market is spinning its wheels, caught in a stalemate, which could create some profit-taking among investors and weigh on prices in the near term. Central bank buying has lately become the dominant driver of the gold market. Last week, the World Gold Council reported that central banks continued to add to their gold reserves in February, which pushed gold prices to new record highs. Despite Western central banks' efforts to manage their heavily rehypothecated gold reserves, Maguire warns of a looming threat to U.S. dollar hegemony, spurred by the adoption of the BRICS gold-backed currency. Let's get back to the interview.
The current 2-month, over $400 gold rally has been fully embraced by European, Asian, Middle Eastern, BRICS Plus, and a string of the pipeline BRICS adopters. These NSFR-compliant central banks view this gold price appreciation as helpful. It raises the current backing of around, it's a fairly unified plus or minus 4% of gold reserves versus GDP backing up their respective foreign exchange currencies. Now, into the gold price rise, NSFR-compliant central banks haven't had to tap into their respective gold revaluation accounts to bolster this percentage of gold versus GDP that ultimately benchmarks their respective currencies versus gold. So far, that is, but it's coming. And when Glasnev's gold-backed BRICS currency is formally launched and it is realized that the currency is far more liquid than was assumed, because it's ultimately backed by what liquidity providers assess as an aggregated 60,000 tons of gold. And of course, we've in the past, we've done episodes on how China views this. In the event of war, the PBOC has telegraphed that they can equitably access the over 20,000 tons of citizens' gold and provide on a return basis. And that's all, they've outlined that fully. So when you think about it, this is a huge amount of gold. Western-facing central banks will be forced to raise the percentage of gold held versus GDP to mitigate this upsurge of inflationary pressures of commodities paid for in dollars. forcing a global gold price revaluation event. As the dollar depreciates against these goods benchmarked by the alternate BRICS gold-backed settlement currency, the scale of the completely unfactored inflationary pressures poses a hypersonic threat to the US dollar hegemony, which will catch Western central banks off guard. And this is why we're evidencing a desperate attempt by the US frontline leaders to try and buy time to unwind their 8,133 tons of rehypothecated, deeply underwater central bank gold reserves. They will do everything in their power to try and undermine the key Sino-Russia currency anchor. The latest multi-billion-dollar Ukraine funding to try and undermine Russia is just one more string that they're pushing on to buy time. But the jig is up. As we've looked at closely over the last 2 months, the rally in gold has defied the experts attempting to understand the real reasons gold and related silver have rallied without and despite the lack of paper-centric CDA participation. Now, an official effort to cap the gold price, and all official efforts to cap the gold price for that matter, are limited to how many momentum-driven CTAs that they can lure into going long or short, because they're never going to make delivery or take delivery. And the drivers that have forced the dislocation from a full spectrum of programmed algorithm bots, which have historically traded inversely to a stronger dollar index and rising treasury yields. So this has served to wrong foot the over-leveraged paper-centric momentum-chasing CTAs.
The buying spree has also taken hold at central banks, UBS said in a report last week, citing some central banks' desire to move away from US dollars and hedge against inflation risks. As we witness the unfolding dynamics in the gold market and the broader issues, what do you envision as the most significant implications for global economic stability? Drop your thoughts in the comment section below. If you find this video informative, don't forget to support our channel and turn on notifications to stay informed about our latest videos. See you in the next video.